Staying consistent in the stock market is a very simple principle. However, in practice, it's a lot harder than it sounds. Now, since 1990 to 2025, if you had remained consistent in the stock market per month, you would have returned an average of 9.7%. Now, 5.8% is the amount that you would have got if you went crazy and every time you saw a dip, you sold out and then tried to buy at a better time. Now, the difference between 9.7% and 5.8% is huge. Let me demonstrate that difference with this compound interest calculator. So let's say you start with £0. You get an annual average return of 9.7%. Let's do that for 40 years. Anything shorter and there probably will be a higher amount of volatility. Now, let's just put in £100 a month and let's see the results. Now, as you can see, over 40 years, if you can get 9.7%, a £100 a month investment could be worth over £570,000. This means that you invest only £48,000 over that time and you gain around £529,000. Now, let's just change one variable. Everything remains the same, but instead of getting 9.7%, we get only 5.8. So as you can see, everything remains the same apart from the average interest rate. We can see how much of a difference that's made. So you still invest a total of £48,000, but your return is now only £188,000 in total, gaining only £140,000. Now that is how much just 3.9% difference makes in terms of interest. Now, despite all of that data, I am still guilty, unfortunately, of sometimes trying to time the market. And in this video, I'm going to show you what I potentially lost out on in the past few months by trying to do this. Now, as always, I'm using the Trading 212 platform. And if you would like a free fractional share worth up to £100 when you sign up to Trading 212, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but have not received your free fractional share, all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see this section, use promo code. And in this menu, just enter my special code JUBAIR and you should receive a free fractional share. So over the past nearly 3 years, I've always shared my portfolio with you guys. You can go back and see how that's changed. And I believe in portfolio transparency. And as the name of the channel suggests, this is my finance journey. So it's always going to be about my money. I know this channel isn't for everyone, but thank you for 16,000 subscribers. But anyway, as you can see, over the past month, my return has been suspiciously steppy, as you can see, very consistent. And that is because I have been in cash at a time when the S&P 500 has, actually boomed, which of course I have lost out on a significant amount if I hadn't done that. Now, the thing with hindsight is that it doesn't work in present day, so the opposite easily could have happened. And this is one of the points that I made in the beginning. If you stay consistent, you're probably most likely going to be rewarded better than if you try to dip in and out of the market. However, I have been doing this since 2021 and I have returned an average of higher than 10% per year. So I think I've been lucky. I just enjoy doing this and I would not recommend a single person to do this, nor will I ever tell you when I buy and sell, because I really do think that is irresponsible. But anyway, I think it was the 11th of June that I sold out of all of my S&P 500 holdings. Now, this is the fund that I was invested into. This is the iShares Core S&P 500. This is a currency hedged version of the S&P 500 tracker, which essentially means that it follows more similarly to the one that you'll see on Google Finance, just because, of course, the currency is hedged. When I speak about a certain ETF, it is not a stock recommendation, by the way. Anyway, you can see over the past month, this ETF is up by nearly 5%. So that's 5% that I potentially lost out on. However, let's do a bit more digging, because did I really lose out on 5%? So history is my best friend here. You can see on the 11th of June, I sold out of all of my holdings. I sold out for an average of £10.20. At that time, it was actually the high, and if I had bought back in the next week, I would have been up by 5%. So I had around 11,700 shares in the iShares Core S&P 500. So for every penny it has gone up by, I would have gained £117. Now, if we do the math, for every share that I had, that's 41 pennies gained. So I would have had around 4,800 extra pounds. So as you can see, here is my portfolio, which isn't actually looking that bad. The current value is £118,000. However, it would have been well over £120,000 had I remained invested into the iShares Core S&P 500. Now, to make things a little less worse for me. I did gain interest on that uninvested cash that I had after I sold out. So as you can see, currently I have £117,000 in cash. I do not actually like having cash. I think every single day that you are in cash is money that you are potentially losing out to the stock market. So I don't advocate having this much in cash. But either way, as you can see, that is a daily interest of £13.70. Do bear in mind that this cash is mostly put into qualifying money market funds, which is still a class of investment, so your capital will still be at risk. So over that time period in holding cash, I gained around £535. This would mean that my total loss in selling out is around £4,200, taking into consideration that interest that I lost out on. And that really does hit home hard now, doesn't it? Staying in cash has literally lost me around £4,000 over the past 1.5 months. I guess you could make the counter argument that the S&P 500 could easily crash and the amount that I have now will stay the same because I am in cash. And that is the thing with the stock market. It is absolutely not guaranteed what the next step will be. Now, even though I have made that loss, that is still not a loss that is guaranteed to me, as the stock market could easily just go up and down. But we know over the very long term that staying consistently invested into something is probably going to give us a far superior result than, going in and out of the market. Now, keep that thought in mind, because on the 24th of February, I was all in cash, £116,400, and I was really happy with that. Now, what I did then afterwards is to go all into the S&P 500, which in hindsight was a very bad move. Shortly afterwards, the value of my portfolio dipped to well below £100,000. Now, if instead I had stayed in cash, I could have just waited out that dip, and if I had bought at the bottom, which again, hindsight is 2020, I would have made over £24,000 in gain. So yeah, there is definitely a potential, if you can time things right, to make a lot more than just staying in the market. However, the average person is just not going to be able to do that. When emotions are in play and when your actual money is on the line, pretty much no one ever beats the market. But that does not stop people now, does it? I'm going to keep you guys updated on my financial journey as always, so I would appreciate a subscribe. I never actually asked for subscribers. I'm really grateful for the 16,000 that I've gotten. So make sure to check out some of my other videos, and I'll see you in the next video.